Hi! Have you seen the gloomy headlines about European car manufacturers? The word crisis resonates strongly. The flood of Chinese cars is widely reported. Chinese competition, falling sales, tariffs, and so on. The shares of major European car manufacturers have experienced significant drops. But is it really that bad with the European automotive industry? Or maybe this is an opportunity to buy good companies cheaply, taking advantage of the negative sentiment? In this video, I will show you two companies that are worth your attention. But first, let's face the reality. Chinese brands are flooding the European market. BYD, Geely, Omoda, Xpeng, only to name a few. According to the latest data from market analytics firm Dataforce, Chinese brands captured a record 7.4% share of Europe's passenger car market in September. But that's not all. European automakers are facing also U.S. tariffs. That could force them not to sell less profitable models in the U.S. And European car makers are losing market share in China to Chinese competitors due to intense price competition and the rapid technological advancement of Chinese brands. Now, you probably wonder how European car makers are doing under these circumstances. Let's take a look at two of them. First, Volkswagen, a German company based in Wolfsburg. So, let's take a look at the results published after the third quarter of 2025. They can be found on the Volkswagen website in the Investor Relations section. First of all, you need to know that it's a multi-brand manufacturer. Skoda, Audi, Porsche, Bentley are all well-known brands with their fans and loyal customers. Okay, what about their sales? Have they dropped? Not at all. Over the first 9 months of 2025, they delivered 6.6 million vehicles, which is 1% more than during the same period last year. And their global market share remains stable, above 10%. What's even more surprising, current order intake in Western Europe is up 17% year over year. Yes, they have a significant drop in China and the USA. But in Europe, they grow by 4%. In South America, by 15%. This more than offsets the decline in China and the US. Okay, sales remain stable, but what with the margins and operating result? Well, they're down by more than 50%, mainly due to price competition, tariffs, and restructuring costs. Also, Porsche goodwill impairment had a significant impact on the operating result. The management is fully aware of the market situation and is taking appropriate steps to improve profitability. This includes reduction of workforce and manufacturing capacity. According to their estimates, this should bring cost savings of more than €6 billion by the end of decade. They also work hard on new model campaign to beat the competition. Some of these models have already been released this year. Others are planned for 2026. What's interesting, Volkswagen is strengthening its position as a market leader in the electric vehicles segment in Europe, with over 25% market share. Okay, let's sum up. Volkswagen is a company with strong, popular brands. Their sales and market share are stable. Restructuring is ongoing and new models campaign is taking place. Now, let's look at the numbers. Volkswagen is a huge company with €53 billion market capitalization, currently trading at a price-to-earnings ratio of 7.7 and price-to-book value of 0.28. Well, that's cheap. That's bargain. The dividend yield is over 6% with payout ratio of 51%, which means the company keeps half of the profits for further investments. For such a large manufacturer, one of the market leaders with strong brands, this is a really favorable valuation. Okay, let's examine the second one, Mercedes-Benz. I will review the third quarter 2025 results available on their website in the Investor Relations tab. It shows revenue for the first 3 quarters down by 8%, but it is still €98 billion. That's not bad at all. Their net profit is down by 50%, just like Volkswagen. Well, Mercedes is facing the same tariffs, price pressure, and restructuring costs. If we look at revenue by region, we can see that sales in Europe are stable. A significant drop is in China by 27%, and in USA by almost 9%. What's important, sales of the top-end vehicles and electric vehicles increased in the third quarter by around 10%. Top-end is the most luxurious segment like Maybach, AMG, EQS, and so forth. It is also the most profitable, with the highest margins. Mercedes management kicked off the biggest ever product launch program. They aim to beat Chinese competition. And, what's even more important for shareholders, they've just started a new share buyback of up to €2 billion. So, let's sum up. Mercedes has an incredibly strong brand. It's like Coca-Cola. People won't stop buying Mercedes. Total sales are slightly lower, but top-end and electric vehicles sales are growing. Restructuring is ongoing, and the biggest ever new models launch program has just been kicked off. Now, let's look at the numbers. Mercedes is a large corporation with €57 billion market cap, currently trading at price-to-earnings ratio of slightly above 9 and price-to-book value of 0.6. The dividend yield is above 7% with payout ratio of 66%, which means the company keeps 1/3 of its profits for further investment. Well, that's a very fair valuation. Regarding the brand, the product portfolio, the high-end technology they possess, it's a bargain. This will be more visible when we compare these two manufacturers with their American competitor, Tesla. Tesla is currently trading at 300 times its earnings, 19 times its book value, and pays no dividend at all. Okay, Tesla manufactures not only cars but also robots, batteries, chargers, and so on. But anyway, the difference in valuation is absurd. Well, in my opinion, German car makers haven't said their last word yet. Mercedes-Benz is aggressively expanding its presence in China, investing more than 14 billion yuan in local partnerships, expanding its product portfolio, including exclusive electric models, and strengthening its research and development center in Shanghai. Volkswagen, too, is significantly expanding production and research in China as part of its In China for China strategy to compete with local brands. This includes a €2.5 billion investment in the Hefei Innovation Hub, which is now fully capable of developing vehicles from start to finish outside of Germany. This expansion allows for faster development, lower costs, and allows Volkswagen to better serve the Chinese market. So, that's all. Did you like it? Subscribe.